Hi everyone, welcome back to the Market Chat. My name is Richard Moglen, and joining us today is Brian Shannon of alphatrends.net. He's also the author of Technical Analysis Using Multiple Timeframes, a highly recommended book. So Brian, thanks so much for doing this. I've learned an immense amount from you, and I'm really looking forward to this.
Great. Thanks for having me on, Richard.
Of course. And to kick things off, I'd love to just hear a little bit more about your background. And for people who don't know you, how did you first get interested in the business, and what's kind of been your journey and progression thus far?
Yeah, sure. I'll give you a quick overview. It really, my interest in the market began when I was about 14 years old. I would hang out with my dad, and he would be on Friday nights. He'd watch Wall Street Week, and I just wanted to hang out with him. So I would, lay next to him, and we'd watch Wall Street Week together. And it didn't make sense, but I started picking up on things, and it was a kind of a way for me to connect with my dad as well. Fast forward, to actually the very first time I got interested in thinking of buying something was in the 70s, which was silver, when the Hunt brothers were cornering silver. And I said to my dad, hey, can we get some silver? And it was, I think, $5 an ounce. And he bought some silver on my behalf, and it went to 52 or whatever it went to, and it was kind of crazy. I didn't really do anything for another 3 or 4 years until I found another company called LoJack, and kind of the same story. I had $500 saved up. It was a $5 stock. I said to my dad, hey, I want to buy this. He said, I'll lend you $4,500 and you can control 1,000 shares. I didn't realize I was getting, basically 9-to-1 leverage. I just thought, hey, cool. I have more shares. I didn't even think about risk or the fact that it might go down. And maybe the worst thing that could have happened is that it never did go down. And about 3-4 months later, it doubled. And I said, hey, Dad, I want to sell. So I made $5,000. He gave me the leverage. So I was basically hooked on it since then. I was never a really great student in college. I mean, I was capable, but just not, lazy and not interested, I guess. I think a lot different than maybe you, Richard. I think that we would have been much different students. But anyways, that's a compliment to you, by the way. I then went, to college for business and graduated and, became a retail stockbroker and just hated it. I didn't realize really what a retail broker meant. It's a sales job. It was a glorified telemarketing position, really. But it gave me a lot of great skills. I mean, I wouldn't trade it for anything. I learned how to sell. I learned, and that was at Lehman Brothers in Boston. That was 1991. And I learned about stocks. The guy that I was, working for, I was, an assistant broker, a junior guy. I, qualify leads, open accounts, and that sort of thing for him. He was into technical analysis, and he, would get the daily graphs, chart books, and he would let me take them home, and I would just devour those things. And we were, I was, his strategy was earning surprises, positive earning surprises. When a company reports better than expected earnings and it breaks out on the chart. So right away, I got to blend the fundamentals with the technicals. Now I've gravitated pretty far away from the fundamentals because it's not trying to sell a customer on a stock anymore, where it used to be, you'd start with the idea and then you'd kind of find all the ancillary pieces of information to try to create a good story so you could sell it to people, basically. Hit their triggers and get them to buy over the phone from some 22-year-old punk who had no business selling you stock. So anyways, I had been a broker for a couple of firms, moved out to Denver in 93. And then was a broker here for a while at Dane Bosworth. And then, in the back of the Investors Daily, there always used to be this ad, leverage trading, trade for a prop firm. So I answered that ad. I got, scraped my $25,000 together. They gave me 20-to-1 leverage. It was a firm called Generic Trading out of New York. And I was profitable because I was so scared to lose, but I had good habits that I had learned as a broker. In other words, unfortunately for the customers, and it didn't work out this way. I never, blew up customers, but I got to practice with their money. And I saw the value of risk management and cutting losers and the things that you're supposed to do.
Right.
So I was never making much money, but I was consistently making money. And then I figured, well, I've got to do something else because, such a small capital base. I started a day trading firm in Denver so this was, the SOES period, basically. I started a day trading office with a partner, and we then sold that to a competitor, which was MarketWise. I started a class for them and headed the proprietary trading department for MarketWise, and left them probably about 14, 15 years ago. Kind of started doing YouTube videos. It was actually Google video before YouTube was actually in existence, and just kind of been doing my trading, communicating about it. As far as Alpha Trends goes, it kind of was brought together because of Stock Twits. Howard Linson had seen my videos and said, "Hey, you want to start a subscription product? Why don't we'll do all the back end. We'll do all the back end stuff, and you can just focus on the market." So that's kind of it. Fast forward to where we are today, as you pointed out, I wrote the book in 2008, which continues to be well received, and I'm working on a new book on the anchored volume weighted average price. It's a slow, painful process, but I promise it's coming next year. And that's where we are today. I'm a swing trader primarily. I do some day trades. I don't try to day trade, but the market forces you to sometimes, or it doesn't necessarily force you, but sometimes just that's what the opportunity is. I try to get my cues from the market rather than tell the market, here's what I want in terms of time frame and that or anything.
Yeah. And you're kind of the original stock market YouTuber, which is interesting. You're the first one who made the video. So if people haven't watched Brian's kind of weekend videos, highly recommended. Really just gets the meat of it. No BS, none of this extra stuff. So definitely highly recommended that. And I'll have your YouTube channel linked below.
Right.
Brian, I want to hear, because everybody, especially as they're going out, kind of goes through kind of the same mistakes over and over. So what were some common mistakes? You said you got the risk management side of things handled pretty quickly, but what were some mistakes you kept making? And then finally, when you fixed those and analyzed those, it was kind of a turning moment for your performance.
A few things. One, believing that my opinion mattered to the market, thinking that, hey, I would look at the fundamentals and they would be great. Kind of what people are going through. I think a lot of people are going through right now, looking at Peloton, looking at Zoom, looking at DOC, looking at all of these growth stocks that are just getting annihilated. They're hanging on to, but their revenues were up 123% and earnings were up 326%. Yeah, it's down 60%, but it's a good company. It's down too much. I'm going to keep buying the dip. Well, it's no longer a dip. These are broken stocks. And I used to make that mistake. And fortunately for me, it at some points it just got to be, I would ride, losers down, but never for more than a week or so. I'd be just like, you know what? I've been fighting this thing. I'm being stupid. I've got to rip the Band-Aid, pull all the hairs, just get on with my life. It's going to suck to have to fight back. So I never held them long term. Hey, everything comes back. Right. And a lot of people are going to get themselves into that situation, and they're going to waste a lot of years looking to get break even on these names when you should just be done with them and move on. So, that was a big mistake, was, believing my opinion mattered, believing that stocks were down too much, believing too firmly in what I was seeing in the fundamentals. And using that as a crutch to justify holding a losing position. And I got over them the hard way. Just, the best lessons for me have always been, I got to learn it the hard way. You got to punch me in the nose and, maybe a couple times, but eventually I start realizing, that kind of sucks. I don't want to get hit anymore.
Right. And, you're kind of famous on Twitter for your saying only price pays, which kind of goes along with what you just said. So yeah, could you expand a little bit more on what that means to you and yeah, the main message behind that sentence?
The main message behind that sentence, Richard, is it's a mantra I tell myself too, because we all hang on to this little thing that guy on TV said, or look at the fundamentals. It hits the CANSLI and the M all together. Maybe not all together because price isn't, confirming it, but we hang on to this information. We look for divergences and we say, well, it's a divergence. It's down on lighter volume, so I'm going to hold on because it's on light volume. People will say, I want to buy the dip. I'm going to buy at the moving average. I want to buy at the anchored VWAP. I want to buy at the retracement. To me, all those tools are the same. Tell us the same thing. They tell us a level of interest only, not an action point. So when it hits the 50-day moving average, I'm not going to be the guy who sticks the bid in. I used to be that guy. Hey, the 50-day moving average is support. No, it's potential support. And what it tells us is here's an inflection point possibly. We want to look at this on a shorter term time frame and look for actual evidence that the buyers are making a stand here. Sellers are slowing down. And if it emerges out of there with strength and I can manage my risk, then I want to be involved. I don't want to just buy blindly. So I use the volume weighted average price constantly. I'm talking about it. I have to. I'm writing a book about it. That's not why. It's because it works. It provides better signals than anything else. But I'm not just going to blindly buy as it touches it, just like I won't buy as it touches a moving average or a Fibonacci. It's a level of interest. So that's all good supporting information for the only thing that matters. The only reason we trade is to increase our P&L, our money. It's price. It's price action. That's the only thing that matters at the end of the day. It's the only thing that pays. You can find 12 indicators that say it should go up, but if the price is still going down, price is what matters. Only price pays, and we're interested in getting paid.
Absolutely. Absolutely. And going back a little bit to your journey and your background, I wanted to ask you whether there are any particular books or maybe other types of resources that were really helpful for you in developing your own style and teaching you kind of the right way to approach things when it comes to trading.
Yeah, I knew you were going to ask that question. So, of course, Stan was, the biggest influence probably early on. I read that book in 1989, and I remember exactly where I was when I was reading it. I was on an airplane to Alaska, and I devoured the book, and it just made so much sense. And I've obviously adapted a lot of what he's taught me into what I do today. So huge, shout out to Stan. Another book that's not as well heard of is this one, How Charts Can Help You in the Stock Market, by William Giler. And this was written in the 60s. It kind of goes through, head and shoulders, double tops, and that sort of thing. But what it does a better job of than any other classical technical analysis book that I've seen is that it goes through the psychology of the pattern. Right. It's not just enough to recognize a cup and handle or an ascending triangle. What does that mean? Any monkey can point out a head and shoulders. Right. And a head and shoulders is just a basic reversal pattern. We had higher highs and higher lows. We have a lower high, and as soon as it makes a lower low, the pattern's complete. Well, it's just a reversal with a name because it looks like a guy standing there, with his shoulders shrugged. So that's a great one. And the third one, I would say, this is a newer book. Mm-hmm. And this one is by Brad. I don't know how you pronounce his name. Yeah. Anyways, but it's the book about Taser, basically. Yeah. And I was trading Taser during this time, so it really rang true to me. But I don't think there's a better book about someone who describes the action in a stock over a real big, momentum campaign over the course of a year and a half. That encompasses here's what the shorts are doing, here's what the promoters are doing, here's how the moving averages acted and why they were, there was support or resistance in those areas. So those three books were probably most influential. Probably not the last book as much because that's only been out, I think, the last 6 years or so. And I've been at this full time 30 years now. But it's important enough that I would say if I were newer in my career or I'm talking to people who are newer, that is one of the top books that you can get into to understand the dynamics of the psychology of the different players. Right. And how they all come together to form the chart.
Right. And on the kind of mental side of trading, is there anything that you've read that you think is really helpful or something that's helped you? Because that's something that I think a lot of just kind of system books like How to Make Money in Stocks or Secrets for Profiting in Bull and Bear Markets kind of leave out. So on the mental side of thing, is there anything like Mark Douglas that's helped you personally? What are your thoughts on that?
No, there's one by Ari Kiev, and I forgot the name of it. I've read that one a while ago. I wish I had pulled that off my bookshelf. Anything by Brett Steenbarger, he does a great job. And there's another one by Martin Pring that is maybe The Psychology of Trading. I mean, it's just that simple of a book title. One of the things I remember out of that book, I think I got this from him, is that when you commit your money to the market, like it or not, you commit your emotions.
Right.
And if you add leverage to that, guess what happens? You leverage your emotions as well. So those books, I would say, in terms of psychology, I've got a section of my bookshelf with about 20 of those books. So what I'll do is I'll take a picture of them all and I'll
tweet it out.
Tweet it with this when you put it live. Yeah.
Perfect. And what kind of tools and software do you use kind of day to day as a part of your process?
I use several of them. I have TC2000 is where I do my main charting because I can spread it out across 5 screens here in front of me and have as many windows open as possible and flexibility. I use TrendSpider as well. MarketSmith is a big one. I almost any time I look at a stock, I want to be sure I look at it on MarketSmith as well. So I have a little bit of fundamentals. Just that snapshot of fundamentals is what I'm looking at. So when it comes to fundamentals, I want to know 2 things. Are they selling more stuff, whether it's taser guns, whether it's Tesla cars, whether it's coffee or whatever, and are they making more money selling that stuff than they were year over year and sequentially if possible? Those are the 2 most important things to me. I don't pay attention to, PE ratio or cash flow. The fund holdings I look at once in a while, and that's really good information on there. But they tend to be a little bit slower. There's lag between that. For my time frame, it's not as important because I'm not looking to hold a stock 6 to 12 months.
Right.
But they've got in short interest is important. So there's unfortunately there's no perfect trading platform. So TrendSpider's got some great stuff. TC2000 has some great stuff. MarketSmith, and I realize not everyone can get all of these tools, afford them, or whatever. But you've got to find the ones that have the tools that are most important to you. Something that people forever have been asking me for the last 8 years. Hey, Brian, can you get the people at Thinkorswim to add the anchored VWAP? And I've emailed them. I know thousands of the customers have. They just refuse to do so, and people will just continue to complain about Thinkorswim rather than go pay $25 a month for another software that has it. If you think the tool's that important, which I believe anyone's trading without VWAP is trading blind. But if you think it's that important and you're going to ask people, hey, can you post a chart on Twitter for me with the VWAP of this? Get out of here. Go pay the $25. Do it yourself. Learn something. And it's a valuable tool. Pony up. You can't compete against professionals without professional tools. You don't need all of them, but one or two of the ones that I mentioned is good. And there's, and if you can't afford those, there's great free resources out there. TradingView has an anchored volume weighted average price for free. Yahoo Finance has a version of anchored volume weighted average price for free. The stuff is out there. Do some digging, people. Do some work. Be intellectually curious. Don't just ask for answers on Twitter.
For sure. And going back a little bit to your time frame, because I think it's helpful for everybody watching to kind of know kind of how you trade. What would you say kind of your average holding period is for a winner, a loser? If you've got your kind of batting average stat, average gain, average loss stat, that would be great to know as well.
I'm not a big stats guy. To me, it's more about, my results and how I'm doing in the current market environment, right. And focusing on, am I making mistakes? Am I not executing properly? Am I abandoning my plan? Am I making emotional decisions? Those are the things that I keep better track of than I make, 2.6 R and I lose 0.8 R per trade.
Right.
But I will say that my time frame is I consider myself a swing trader. Mm-hmm. That's what I want the market to allow me to hold. Mm-hmm. It's up to the market to tell me how long. If I'm wrong, oftentimes I'll be out the first day. So losers ideally should, as we know, we should hold them less time. Yeah. And, when I get stopped out the first day, and I don't like my losers. People say you should love your losers, but, I still don't like to lose. But I like the fact that when I have a loser, I want it to be quick and decisive and say, hey, the market didn't agree with my analysis. Was there something wrong with my analysis? Or is this just normal market behavior? I got bounced out. I can move forward, go on to these other names. Ideally, my swing trades are 3 days. 3 or 4 days is kind of the sweet spot. Mm-hmm. Once in a while, I will hold a portion, generally my last third of a trade, for up to about 3 weeks. But beyond 3 weeks is really kind of rare. This year, I've experimented a little bit with some really small positions and holding them for longer periods of time. And I've got 50 shares of NVIDIA that are more than a double. So that's kind of helping me, migrate to a longer term time frame. But right. Generally, a swing trader, 3 to 4 days is most typical, I think. I often get out of the first third on the first day if there's a nice move. Mm-hmm. And a nice move I consider to daily R2. There's usually, let's say it's a $30 stock. That might be a move of $1.20 or so, daily R2, or a short daily S2 might be similar to that. And that's simply because, one of my primary strengths is the function of the way I look at the market with multiple time frames, is that my timing into the stock is usually pretty right on. Mm-hmm. I'm getting at the sweet spot. So when I do that, I go a little bit heavier than I would suggest other people typically do. And because I do that, and sometimes I help provide the momentum at that key breakout point, I want to sell some quickly just to take that initial stress of the trade off, mm-hmm. to reduce my overall risk. So if my risk was $1 and I take $1 off, well, now my risk on the 2/3, overall is 66 cents. So I've, reduced the risk to 66 cents overall. That means my per unit is only 22 cents risk, mm-hmm. because I've taken that first third off. So it really helps me diminish my, right away be in the position of strength. I always want to be in a position of strength as early as possible. If the market lets me raise my stop on that long to the most recent, underneath the most recent relevant higher low for that time frame, mm-hmm. and then if we get a nice push higher, I'll take a little bit more off maybe and trail the stop up on the balance.
Perfect. And I definitely want to dive in deeper with multi-timeframe analysis and all of that. But first, this is kind of my favorite subject to talk about, because I think it's so important to kind of approaching trading as a business. And that's the subject of weekend and daily routines. So I'd love to hear, first of all, kind of your weekend preparation. How do you set yourself up for success that next week by putting in the work on the weekends? Yeah,
typically, and I've kind of had this routine for 15, 20 years. I don't even know. What I do is, I'll look at, like I said, on TC2000, I have 6 timeframes. I have a weekly, daily, 30-minute, 15-minute, 10-minute, and I'm sorry, daily, 65, 30, 15, and then a 2-minute over there. Mm-hmm. So I populate each and every one of those timeframes on every chart that I look at. So I'm looking at 6 different timeframes at once, and I'm not studying them, but I'm looking quick glance. I have kind of a mental checklist that I don't even. It's just become routine. I don't. Right. It's not like I think, well, okay, take the backswing up to 3 o'clock, and it's just muscle memory at this point.
Right.
But I have what I call my master list of stocks that I review on the weekend, and that's about 1,000 stocks. So I look at 1,000 stocks on 6 different time frames, and it sounds like a lot of work, but it's also, to me, it's fun. It's like a treasure hunt. I'm finding information out about the market. I could create scans. In fact, once I created a scanner called the Alpha Scanner, I made it as a commercial project, put about $50,000 into this thing, folded it up because I never used it because I found I wasn't getting the same feel for the market.
Exactly.
When I go through these 1,000 stocks, I can do it in about an hour and a half. So I'm going pretty quick. And then what I'll do is I just, start making notes that look like, this. I'll just write down a bunch of symbols, and I put stars next to the one that looked the most timely. And of those 1,000 charts, I know I'm not going to trade them all. I mean, no one would, but I start to notice things, and I start to say, hey, that's the 3rd oil name and I'm through the F's at this point. So I do them alphabetically. That's the 3rd oil name. And I've seen 2 biotech stocks that look weak. So I'm starting to get intelligence about the market, and I'm starting to see patterns. Hey, this one's breaking down. That one's breaking down. And then I'll go look at the biotech index, and it hasn't broken down yet. So I see some of the leaders are breaking down, and an index seldom moves before the components. The components move first, and the strongest ones or the weakest ones start breaking down first. So I get a better feel of what's the inner workings of the market. So I'll get that list of 1,000 down to about typically 150 to 180 that I want to look at for the next week. Now, in that 150 to 180, I know that there's 100 of them. I know there's probably, let's say there's 180. I know there's probably 150 of them, 160 of them that I just won't trade this coming week. Maybe there's 20 of them. But I'm looking, and I might not trade Apple, but Apple's always there, Amazon, Facebook. I look at all the leaders, and I want to look at those every day. Not because I'm going to trade them, but just for market sentiment. What are the leaders doing? And then I'll look at some of the little speculative names as well. And I'll look at everything in between. And then I'll look for what are the sweetheart setups that I think could go on Monday or maybe Tuesday. And I'll look at those a little bit closer, and I'll get that down to about, let's say, 30 stocks. Mm-hmm. So on those 30 stocks, I then look at those, and I say, these 2 are my A-list stocks. These are the ones I feel I need to focus on Monday morning when the bell rings. I'll set my alerts on maybe 30 stocks, but I won't trade them all. I just want to know when it's hitting a level so I can reset the alert sometimes. To say, okay, it's approaching this level. That makes me want to put it kind of up forward a little bit more. So I'm always just, trying as best as I can to listen objectively to the market rather than run scans and say, here's my shopping list. I want stocks above the 20 and 50-day moving average. They pulled back 3 days. Volume declined each of those 3 days. And those are good scans. I mean, you can find good ideas with scans. I've created dozens of them. But I always go back to, I get a better feel by doing it manually and seeing where the pockets of strength and weakness are rather than just saying, okay, I want these setups. Hey, there's 2 biotechs. Okay, cool. I'm going to trade biotechs this week or whatever. And then I go down and I have my B list ideas and then my C list ideas. And I might trade 3 or 4 of those stocks any given day. 1 or 2 of them, ideally I can hold. Maybe 2 of them, one of them I get stopped out with a loss. Maybe one I day trade for a profit. And kind of move it from there. I have a light issue here. My light is falling. Yeah. It's anyway. So, and then what I'll do is, so I have that list of 150 for the week. I'll repeat that process Monday afternoon, Tuesday afternoon, Wednesday, Thursday, and Friday. So when I look at my list for the weekend, I'm looking at stocks, my list of one that I come up for the 150 to 180. It's not ones that are going to trade on Monday, but I look at them and say, if this happened by Monday or Tuesday, then that 5-day moving average could flatten out on Wednesday. Then it could get back above that level. This might be a good swing trade candidate on Thursday. So I'm looking forward on all these. It's Wayne Gretzky. It's not where the puck is, it's where it's going. We can all look at the chart and say, oh, well, the chart tells you nothing but history. Okay, now we anticipate what's next, though. Don't just be the knucklehead who's looking backwards. Anticipate what that means going forward. How do I develop a risk reward objectively based around that, based on the way I know markets structurally trade with the 4 stages and the interaction between the different timeframes.
Perfect. And you've touched on a little bit your daily routine, but kind of starting from when you wake up, walk me through kind of a typical day for you. What are you doing pre-market, during the day, and then also after the close?
Okay. Pre-market, I try my best not to sit down in front of the computer until the earliest I like to be there is 8:30 Eastern. And that's generally if there's an economic number. If there's not an economic number, I like to be at my desk around 9 o'clock. And people will say, well, don't you feel lost? I don't like to trade pre-market. The only time I really do anything pre-market is to liquidate something that's gapping up crazy, sell it to the emotional pre-market crowd. Or if I'm short something and it's gapped way down, I'll cover into the emotional sellers. But if I sit down too early in front of the computer, I start to get itchy. And I start to say, well, I can buy this one. I can get involved early. And this is a weakness of mine. So the way I compensate for that weakness is to make sure that I'm not there staring at it too long. I've done all my homework the night before. So what I'll do is at 9 o'clock, I'll go through my list of my favorite ones. And at that point, that's when I start setting my alerts for the day. And I'll see where they look like they're going to open, and I'll make adjustments. So if I see a stock that I liked above $22.50, I see it's at $23.10, I'll set an alert maybe at $23.80. I'm sorry, $22.80. So I want to know when it's coming back down. I don't want to chase that gap, but I want to know when it's coming back down and start to pay attention to it again. So again, it's more anticipatory than anything. If I think the stock is breaking out above 22.50, it closed at 22.35, I'm going to set my alert at 22.46. I want to know before it actually triggers. I want to put it in a level 2 screen. I want to start watching it and saying, what's the speed of the tape? How quickly are offers being lifted? Is there a huge offer there that just refuses to go away? Are people backing away and hitting bids? What's the overall tone of the market? Are we gapping lower? We're below VWAP. We're below the 5-day moving average. What's going on in the market? And I try to read the headlines of, the main headlines of what's shaping the news for the day. I almost never read a news story, even about a stock. I don't want to know some journalist's opinion and put his spin on it. I want to say, okay, there's news. It's a catalyst. It seems like a positive headline, but it's been up 4 days in a row. I think it's like candidate for uneducated money to buy. And most likely, if I'm long the stock, I should start thinking about where I get out of this thing.
Right.
Because, markets anticipate good news and sell off on good news. So I want to be part of that crowd, not the chasers.
Right. And during the actual day, you say you maybe trade 3 to 4 stocks. Is that just 3 to 4 trades is kind of a usual day? Or, obviously it depends on the market environment and how many setups there are.
Once I get beyond about 6 or 7 stocks, I feel a little flustered. That unless I have a lot of partial positions, they maybe, those little final third pieces on a couple of them where I actually set the stop and kind of forget about them and leave them to the side.
Right.
That's a good problem to have sometimes, but other times when, you've got everything triggering and you're like, oh, I got to buy this one, I got to buy that one. I was like, wait, maybe I'm trading too many positions and, spreading too thin here. So I try not to get more than that open at a time. Mm-hmm. During the day, I mean, if I buy a stock and I like it for a swing trade, I get involved early and I see it run up, I take that first third off and it comes back down, retraces half of it, holds on the VWAP and starts to run back up. I might add that piece back at that higher price, but not on the pullback. As it pulls back intraday and starts to bounce from VWAP, I'll buy back my original piece with the intent that I'm going to day trade that piece as well, just to scalp a little bit of extra income while I hold on to that, original 2/3 piece that I have. So I scale in and out a little bit at times as well. The older I get, the lower number of trades I tend to do, and I think that's probably very common. Yeah. So I spend a lot of my day going through my list over and over again, resetting alerts, trying to determine, hey, well, this semiconductor is, the semiconductors are strong. I see that one breaking down and that one breaking down. I've got this one that's maybe a second tier semi, so I'm just going to boot this thing because those other ones are breaking down, and I don't want to be, I'll listen to the sector as well as the market and that.
And then after the close, you're just kind of restarting the whole process, finding those ideas for the next day. Is that right?
Yeah, actually, the process begins closer to about 2:30 Eastern. Around 2:30, looking at my trade results over the years, I tend not to put on winning trades at the end of the day. It's been one of my least profitable periods of time. So rather than sit there and try to fight, and Jones for trades and do stupid things with my money, my process of looking at my 150, 180 stocks begins at about 2:30 Eastern. So by the time the bell rings, I've got my list of 20 names that I want to cull down. And then I can, come up with my trading plan. And a lot of times I've got my work done completely by 5 o'clock Eastern. That includes, putting out a video with the ideas for Alpha Trend subscribers with the suggestions in there. And, it allows me to be more efficient and have a life outside of the market.
Absolutely. And I was going to ask you, kind of what do you do outside of trading to kind of forget the market for the time being and just kind of reset for everything? And I know you're a big fan of fishing, so I'm sure that's something you're going to mention.
I love going fishing. I love hiking in the mountains. It's ski season, although we don't have any snow yet, or very little, I should say. I like to bike. I like to swim. I'm an outdoor person. I like to spend a lot of time outside, and I do love going fishing in rivers with my dog, especially. And I go to the gym when the mountains aren't accessible. I go to the gym a couple times a week and try to, stay healthy and active.
Perfect. All right. So, Brian, I'd love to just get into the meat of your strategy and kind of hear more about the tools and indicators that you specifically use. So first of all, I'd love to just ask you about the VWAP, the volume weighted average price. If you could kind of briefly describe it and also talk about how you utilize that particular indicator.
Sure. So on the screen right now, this is the S&P 500 for today. We're looking at a 1-minute time frame. And here you can see I've got this volume weighted average price. It starts at the very first minute of the day. What a lot of people say is, where do you anchor it from the high? Do you anchor it from the low? Do you anchor it from the midpoint? The way that the volume weighted average price is calculated on this charting platform and most of them is whatever that first period is, in this case, 1 minute, it takes the open, the high, and the low close for that period and divides it by 4 and considers the volume, obviously, in that calculation as well. So that dot right there that you see where we started today, that is the actual volume weighted average price of the first minute of trading today. Mm-hmm. It's a cumulative average that changes with price, time, and volume. So it tells us that the market gapped lower this morning. Clearly, we were lower, and that's bearish. But the first half hour of the day, who was in control? Were the sellers really in control? The buyers were in control. We know that because they came right in, and the average price for the day was rising right up to that point. So the buyers controlled it for that first half hour. They said, we're buying this dip. Then the market gap, didn't gap, but traded below the volume weighted average price right here and found resistance at it. Mm-hmm. And then it kind of came up through it, a little bit of slop. Later in the day, it was, back and forth. And then we had a nice little rally and came right back down. So you can see that there's clear inflection points here at this, just, on the daily volume weighted average price. And I'm starting with the daily VWAP because this was the traditional measurement. It started as a tool in 1988 as an execution benchmark. So if I was an institution that said to Goldman Sachs, hey, sell 500,000 spies for me today, and that institution says, how do I know if they did a good job or not? The range was 460.25 up to 465.5. And they can come back to me with any number. How do I know if that's a fair number? Do they give me 463.39? Or do they, just make something up in between? So they said, well, what's the average price that it traded for during the day, weighted by volume? Mm-hmm. So that became the standard benchmark. So today's volume weighted average price in the SPY was right here at about 462.54. Mm-hmm. So if I said sell 500,000 shares of this and they came back and said, hey, we got you filled at 464, I'd say, wow, you guys are great. That's unbelievable. I'm coming back to you tomorrow. If instead they said, we got you filled at 461.5, I'd say, wait a minute, you cost me $500,000. You guys are idiots. I'm going to Merrill Lynch or whoever. So it just gave a standardized execution benchmark tool. And, since then, I first discovered it in a trading platform called Realtick in 2003. The way Realtick did it was they had a trend tool, your traditional trend tool, you draw straight across. Theirs was a volume weighted average price one, and it would go up and down. So it would basically follow kind of like this throughout the day, and the whole line would adjust. It would be a horizontal line. It didn't come as a moving average like this. It represented as a cumulative average, which moves as new time and information. So essentially it's a moving average. It's not a, one period drops off. It's cumulative, but it's an average that moves with new data. So it's morphed into a, as an execution tool. There's a lot of programs that are based around it. And, I started playing around with it. You couldn't anchor it to a certain point, but back then I kind of figured out a hack that I could say, if I set my chart for 4 days, it would start the VWAP at the beginning of the fourth day. And back then it did show as a cumulative average. They kind of changed it in about 2005. So I could get a 4-day volume weighted average price or a month to date or year to date just by saying I would count out on the calendar. This is day 212 of this year. So I go back to 212 days. That will give me the year-to-date volume weighted average price. Today, what we can do is you can see this blue line. That is the year-to-date volume weighted average price. And I have that on every single chart. So I can, anchor it to there. What you'll see here is on AMD, I've got this vertical line, by the way, is just where we were 50 days ago. I move that forward 1 day every day so I can anticipate the direction of the 50-day moving average and when it's going to start to decline and when it's going to end and that sort of thing. But what the anchored volume weighted average price, and that's this tool over here on the right, anchored VWAP by Alpha Trends, you click on that and now I can say, where did the buyers regain control in AMD? Well, we had this, from this peak, we saw that sellers took control for a period of time. But were they actually in control? They were in control for a while, but then, they gained, the buyers regained control here, lost it. It's back and forth. It kind of definitively. So if you're buying, let's say right here, if you bought here, what would I have done? I would have said, well, my stop most likely goes under here, and I would have raised it under there, and I would have been out. Here, I would have said, okay, I'm getting involved in my stop under here. And then we have this beautiful trend. So what I want to say is, from the point where the buyers regained control, right here, I want to anchor another volume weighted average price there. So the buyers regain control. So you can see what tends to happen is from that control point, we saw a pullback and it nailed it perfect. A lot of people are saying, I'm going to buy it when it hits the rising 20-day moving average. And they waited and waited and waited and waited. Instead, we saw it hit that volume weighted average price. Now, as I said earlier, that doesn't mean I'm going to buy there. Sometimes I wish I did, because obviously that was, pretty much dead on the number. That's my cue to look at a shorter term time frame. So I might look at a 65-minute time frame and see where we were back then, and look at these. So, here's another point of control on the 65-minute time frame. This little pullback low is, and then we, so I often, make fun of buying the dip, and I do it just to make a point that you don't want to just blindly buy on the way down. Why would you buy on the way down when the sellers are in control? Where do we see that sellers gain control? Well, when we got below this volume weighted average price, we started to break down right here, lower highs and lower lows. So we know that this was an important high. So we anchor a VWAP off of that. The buyers regained control right here. From that point, the average person the average long was making money, and the average short was losing money. The buyers regained control there. So then we look at that little low and we anchor a VWAP off of that. And we say that's where the low was. And look at how it pulls back. And then it breaks down through that level. And then it breaks down through these other ones. So we want to look at, again, buy the pullback, or buy, after the pullback, when you have evidence the buyers are in control. It doesn't mean they're all going to be the best buys, but they're going to be in the right place. You have absolute proof from supply and demand that the buyers are in control and the shorts are feeling pressure. It doesn't mean it will go higher. And, how do you manage risk is the next point. I probably wouldn't have purchased this one because realistically, I would have thought my stop would have been down here. If I did purchase, it would be a small number of shares, and I probably would have been more interested in another stock that day. And, again, buy the dip, or so let's look at the most recent peak. When do we know that we should put that volume weighted average price there? We don't know that day, but right here, when we make a lower low, we know that was an important high. So we anchor a VWAP off it and go, oh yeah, well, look at that. The VWAP was declining and sellers showed up there. And they continue to be in control. There's no point in buying this dip, because this dip is turning into more of a disaster. If you just buy at 150 because you thought it was down too much, you're unnecessarily down 10% at 135. So the sellers are in control. And here we have that 5-day moving average is declining as well. And that's a key portion of what I do. So back to answering your question, Richard, it started out as an institutional benchmark on a daily time frame. And now it's evolved and morphed into the most exquisite, best, most honest indication of supply and demand that you can find, who's in control from any point in time. What if you thought this was a low and you wanted to buy strength with this as your price target? That's legitimate. It's not something I would do because I don't want to fight the direction of the 5-day moving average, because I know these rally attempts typically fail while that 5-day moving average is declining. But would you buy here with that as your price target? And then what? You get stopped out as it breaks down. So to me, it avoids a lot of unnecessary pain, as well as putting you in when you have absolute, irrefutable evidence that the buyers are in control of the supply and demand in this stock from that point you're measuring from, if that's the correct point to measure from, which you'll know soon enough. And that's why we have stops.
Perfect. And the Anchor VWAP is a tool that I've been trying to use more and more, and I'm excited to learn more and waiting eagerly for your book. No pressure, Brian. But yeah, I'd love to hear more about kind of the spots that you like to anchor it from, because I think that's a big question that a lot of people have.
Yeah. So again, I mean, I always have it on my daily chart, in my intraday. Then I'll start the day looking at a 1 minute chart, just to say, okay, we gapped up, we pulled back, we're back above it. So, the buyers have regained control for this time frame. I feel like this confirms what I saw in that 15-minute time frame. Now I can, the initial pullback is over. Buyers are in control. I have evidence of that. We had that shakeout. As the day progresses, maybe about an hour into the day, I switch that 1 minute time frame to a 2 minute time frame, just because it just gets started scrunched up too much. So I always have the daily. I have, on my daily time frame, I always have the year-to-date volume weighted average price on there. And you can see how, how important it was. Even, I wasn't even planning on talking about AMD. It was just, it's the one that came up. I could do this for any stock and show the value of it. Here it was declining, that failed. It, became resistance broken, became support. Not at the 50-day moving average, but at the year-to-date volume weighted average price. There's a reason for that. The psychology of the institutional investors. How do institutional investors, money managers, get paid? They get paid for performance versus their benchmark. If they own AMD and AMD is below the volume weighted average price for the year, they're doing worse than the average person is in AMD, so they're underperforming. If they own it at $80 per share and it's above that, well, then they're doing well. So at the end of the year, are we doing better than our benchmark? And the volume weighted average price allows us to know that. Investment committees often meet, institutionally for, they make, some of the pension funds only make quarterly decisions, which seems insane. But you'll notice that the quarter to date volume weighted average price, because they'll say, all right, over the next quarter from, October 1st to December 31st, we're going to buy 5 million shares of Apple because we need to take our weighting from this to that. So how do we value whether we're doing a good job of that? Well, for the quarter, they want to know what the VWAP of that quarter is. If it spends a lot of time above that level and it pulls down to that quarter to date VWAP, you better believe they're in there trying to fill as much as that order as they can because they didn't want to chase it higher. Now they've got to make up and get that allocation. Same with month to date. Week to date is a very good one often because investment committees, the hedge funds, they'll meet and they'll have their weekly meeting and say, we're building a position in this stock this week. Turn on the robots to buy, adjust your VWAP programs. I always look at the 2-day volume weighted average price, the week to date. So those are time-based. Event-based are, since earnings, from a gap, whatever the reason of the gap was. Maybe it was the Fed, maybe it was an FDA report, anything that structurally shifts the supply and demand dynamic and says there's a sudden revaluation of this stock. The psychology has changed. Something has changed here dramatically. Now I want to measure from that point forward because that got people's attention. Is it enough to keep their attention? And will they continue to defend that level? A lot of times, you'll see a stock gap up on earnings. It spends a couple days kind of going back and forth. But by the third or fourth day, you'll see that volume weighted average price from that gap, it will not go a penny below it. There is just a bid there saying, we want it. We want as much as this as we can. We feel it settled down. Now we're turning on our program and you start to see it pull back and find buyers at those levels. Hey, it broke out. We have to buy. We have to get involved. Buy on this pullback. Buy on that pullback. Oh, wait, it's below the declining 20-day moving average. Turn that program off. So we're trying to understand what drives the big money because they move the markets. So anything that makes that structural shift in terms of, again, an earnings report, a stock split, a secondary, whatever it might be. If it gets the market's attention and it trades, let's say, at least twice the average daily volume, the bigger the better. Those are great points. So big, high volume points like this turning point right here. So highs and lows. And here, this is a perfect example of volume peaks at turning points.
Right.
It diminishes on pullbacks. It increases, and people will say, well, that's the biggest volume there was. That must be the high. Well, wait, you don't know that yet. It's still above its rising 5-day moving average. It's still rising. Mm-hmm. You don't know, because then we get a bigger volume and a bigger volume. So there's so many pieces of the puzzle that come together. It's not just a VWAP, but it gives us the most objective piece of supply and demand. Moving averages are great trend reference tools, but they're time-based. What's the significance of 20 days? There really is none, other than that's just kind of become a standard that people look at. What's the significance of 50 days? There is none. If anything, we should have a 63-day moving average, because there's 63 days in a quarter. And and it should begin there. 252 days a year. So we should have a 252-day moving average, not a 200-day moving average. Those are side points, but I'm trying to make the point that this gives us the most objective reference point there is. So highs and lows, swing highs and lows. And again, when do you know to put a volume weighted average price on this high right here? Did you put one on it that day? That's not helpful. You want to put it on once it starts breaking down. You say, okay, well, that's the barrier now. That's the high mark that we measured from. If this is in fact a low and the stock starts trading like this in the next couple days, well, then I would say, boom, we'll put a volume weighted average price on that. And I won't start it on the daily time frame. I'll say, here, we'll start it on this time frame right here. And I don't know what volume weighted average price that's touching, but it's something I guess thought was important once before. Anyways, it's right on it. So
yeah.
And the 50-day moving average. So, 50-day moving average often acts as support. Do we see evidence that buyers are in control? I don't see it, not with the declining 5-day moving average. So it's putting all these pieces of the puzzle together, and, it depends on your time frame as well. You can scalp the S&P E-mini on a 1-minute chart, and I've done this. You can look at the S&P and say, here's where we are for the day. And, well, what about when it breaks down here? What about the volume weighted average price from that peak, or once it starts to rally? What about the VWAP from that low? When it breaks below all three of these, we know the average person from this low, from this high in the beginning of the day, are all now losing money, and the shorts are in control right there. So why not short there with a stop above the most recent relevant lower high on that 1-minute time frame, and nice risk reward, lower your stop as it starts to break. Later on in the day, do those become important? As the stock breaks over here, we put a volume weighted average price on the beginning of this move. Look at how well it respected that, right here and right here. And I didn't make this up. I'm just doing this right now. I didn't prepare this. This is the way markets work.
Yeah, awesome stuff. And could you tell me a little bit more about how you use the 5-day moving average as well to identify that short-term trend?
The 5-day moving average, I've said this numerous times, and it's funny I've been talking about this thing for the last 13 years. It has saved me more money than anything else, period, in the market. So, for instance, I spoke a lot about the Russell 2000 in this breakout. When this market broke out, it was a huge breakout, and everyone was expecting this big move. I had also pointed out that we had seen these prior breakouts from consolidations, and they didn't lead to big moves. But, the breakout's great. And if you're on it from the start, that's awesome. But what happens is as long as it's above that rising 5-day moving average, making higher highs and higher lows, to me, it's innocent till proven guilty. As it starts to break down and we see that pattern break, that's when I know that's a near-term turning point. It's a peak. I don't know. I'm not going to call it the peak. That's foolish to say that's the top, but that's an important high because we made the lower low, and the 5-day moving average flattened out. And over here, the 5-day moving average starts to decline. When it's below a declining 5-day moving average, and even if it gets above the declining 5-day moving average, I call it guilty till proven innocent. I want to see, not that it just gets above it, but I want to see a tight consolidation and not a gap. But if it did this, I might have been tempted to buy a little bit with a stop under here. With this as a high level of interest, that's the average price from that peak. It held as resistance here. It nailed it. I mean, just nailed it. You can't make that stuff up. That's not a coincidence. People look, big institutions say, hey, this is a loser. Get out at the volume weighted average price from that high. Then we can look at that and say it's guilty till proven innocent. It was extended here, so don't buy it. It starts to break down. Is it going to do something like this and turn back higher? That would get me interested, but instead it breaks down. It's still guilty till proven innocent.
Right.
So on the upside, again, when the 5-day moving average is rising, I want to give the benefit of the doubt to the buyers if it's in alignment with what we see on the daily time frame. There were several times this year when we were above the 5-day moving average for a week or two at a time, but we were in this big, choppy, messy range. We didn't have alignment of trend. So you want a trending environment like we had the third quarter of last year, and then put a 5-day moving average in there, and you can see the magic of it.
Perfect. And yeah, I also wanted to hear kind of your overall thoughts, and we've kind of been talking about this all along without really saying it, but obviously I want to hear more about kind of how you use multiple timeframes in your process, and also trend alignment. I think would be a great concept to talk about and expand upon. Sure.
Well, and again, that's the title of my book, Technical Analysis Using Multiple Timeframes, How to Profit from Trend Alignment. So a big mouthful. What does that mean? Well, there's, if you ask anyone, what's the trend of the market? Are we in a bull market or a bear market? I think the answer is we're in a bull market. Okay, but are we in a bullish environment the last couple of days? No. So we have trends within trends. Mm-hmm. So big uptrend, and then we had this downtrend in September, October. There's no denying that was a downtrend. We had lower highs and lower lows, but it didn't do anything to damage the bigger picture. So what's your time frame? Where do you fit in? If you look at this and you're a buy and hold investor, no problem. This, everything that Brian talks about is noise to you, and it should be. Just like everything you talk about Warren Buffett and what he's buying is noise to me. I don't care. It's got nothing to do with me. I respect him and I respect what he does, but that's not who I am or who I strive to be in the market. And time frame is so personal. So we have this major uptrend. But when we start breaking down, the trends are out of alignment. We have an uptrend, but is this the end of the market? Is this going to just continue to break down? I never know. I never pretend to know. Instead, I say, well, we had weakness here, and we anchor a VWAP off of that. Where do we have this higher low right in here, and then we get back above that volume weighted average price right here from this peak. That tells us the buyers are back in control. So when I look at that day in late October, it occurred right in here. We're above that rising 5-day moving average. At that point, we're a little bit extended. So I don't have to buy the S&P 500. But the next day, when it gaps lower, where does it come to? I wouldn't be surprised if it touched this volume weighted average price, and it did. So right there, when I'm looking at this, I look at that next morning. I'm looking at my 1-minute chart, and I'm aware that the 3-day volume weighted average price is right there. I might buy some S&P right there with my stop below the low of the day, because I know on that bigger time frame, we have an uptrend on the intermediate term time frame, which is now in alignment with that bigger picture. We had this major stage 2 uptrend on the weekly time frame. big uptrend on the daily time frame distribution, stage 4 decline. This can be looked at in hindsight as stage 1. This is where stage 2 began. I'm not going to be the first one in, but on this day, 2 days later, when it gaps lower, when we look at that on the shorter term time frame, we see that the buyers showed up exactly where they were supposed to defend that level. So those trends are aligned right there. Mm-hmm. And that volume weighted average price for that day, it maintained above it. And again, it doesn't mean I have to trade the S&P, but it tells me we're now in a favorable backdrop. And I can trust these individual stocks that I'm seeing setting up and triggering more so than I could 2-3 weeks. More so than I could 2-3 weeks ago. I got to get a better setup than this. I kind of put it together this afternoon. But you know, I can trust them more than the oddball long relative strength in here. I might have been taking a third or a half position of the leaders in there to test the waters. But at this point, the leaders are already up in here on this day.
Right.
But the other stocks, the kind of middle tier stocks are starting to set up and break from solid bases and not do so with gaps. So those are where my focus becomes. The leaders are already leading. The market hasn't done this yet, but they're saying that's likely to occur. So it's about where we are in that cycle. The leaders lead, then they bring the next guys up, and then the little, turds come up with them. So who's leading? Who's in control? How fresh is this? And it tells me, we sold off pretty hard there. That was a significant correction. Mm-hmm. And from that level, now we're back above the rising 5-day moving average. We've got this pattern of lower highs and lower lows broken on the intermediate term time frame. So to me, this is where the buyers are making their stand. And if not, we take a quick loss, but it's better than chasing up in here on this breakout or, buying this breakout on this day. I want to buy here and sell partial to the breakout buyers because there's always breakout buyers. And you have to ask yourself, where has it come from? Mm-hmm. Well, it just went from 440 to 458 in 5 days. A little profit taking and selling it to the breakout buyers is the smart thing to do here. Doesn't mean it's going to be the top, but oftentimes you'll see it pulls back to that VWAP instead, and you can reload back in here. Doesn't mean it's going to, but that's active trading to me, and that's the way I like to look at it. So again, I covered multiple time frames there. I talked about the weekly, the daily, where we were on this 30-minute time frame, and how that one particular day I would have been looking at the 1 minute chart right there to see that it is interacting with the volume weighted average price from that catalyst, that big shift, that huge shift in psychology that said, buyers are back. Everybody, we switch gears. We're going back to the upside.
Excellent. That was fantastic. And one last question that I wanted to ask you about volume weighted average price is the concept of handoffs and like when that comes into play during a trend. So I don't know if you have an example offhand or you could just talk about it, but what is a handoff and how do you utilize it?
Okay, it's a new point of control. Basically, it's not the traditional point of control they talk about in volume profile, but it's a point of control, meaning that where did the buyers gain control? They gained control right here. And then we saw a test of that level. That was a successful test. So I can hand it off from there. And what I would expect, and it didn't occur here, is that, future pullbacks, so it's an acceleration of this trend. Future pullbacks might come to here and then do this and then anchor a VWAP from there. Right? Let me see if I have one off the top of my mind. I guess we can do it with the probably do it with the daily SPY. And I hope this works. Here's an important level. It tested, that was an important low, so we anchor to that. It tested it here. That's a new point of control. The buyers showed up in that general area. It didn't touch it perfectly here, but I would say this is the new turning point. Right. And you can see that became a level. Then I'd put one here and say, oh, wait a minute. Not only at this point, we knew that this was a high. and the buyers regained control right in here. They lost that control, and we knew that this was an important high right in here. So we kind of have confirmation that now the buyers are back in control from this trend acceleration point as well. And we can now hand it off and say that handoff allows us to say, here's our new point of control. So this is maybe the new point we can raise our stops up under, rather than our stop up under the volume weighted average price from way back in March, which is, not really relevant to current trends right in this area, because it's way down here, or right here because it's, instead of having your stop at 425, now your stop is at 415. And a longer term holder might say, hey, that's good. I wanted it down there. It kept me in for this pullback, which to me is just, it's a month-long bearish environment. So, and on the downside, we see it as well. Did that happen in, I wish I could have, I bet you I have it on my notes in front of me, one or two of them written down. But I can't think of any offhand. So
you could tweet it out later,
sure.
Similar to, perfect.
Yeah, I mean, I put them on Twitter a lot, and I put the little torch on there to make the points as well. Pass the baton, pass the torch, handoff, whatever you want to call it.
Perfect. Yeah, I think this is a really great backdrop and way to think about the market. And once again, highly recommend this book. It goes into way more detail than what we've just been able to do in just 30 minutes. But now, Brian, I'd love to go through some of the trades that you had prepared. I think Bros and Lucid, and just kind of talk through the overall process with that.
Yeah. So, these are things that I've spoken about, and they make the points that I'm always trying to make on Twitter. Have a strategy. And buying the dip isn't a strategy in my mind. Buying strength after a dip is a strategy. So let me share this. And what I decided to do when you asked me for some charts was to say, I'll just grab some tweets. And these are recent ones that I had spoken about. They kind of show these concepts. So on November 3rd, I was looking at Lucid, and a lot of people have had their eyes on Lucid. It had that first big move, and this is a daily time frame on the left. So this was a volume weighted average price from the beginning of that move, and that was from the high. So we had this correction, and it got stuck below the volume weighted average price from that high. And it nailed it there. And then we started crossing back and forth. It had this move. I missed that initial move out. But here's what the 15-minute chart looked like. So we're looking inside this part right here, side by side. So we're magnifying it at a, what would that be, for 26 level magnification. There's 26 15-minute periods in a day. So we're looking at that and saying, okay, this is where this move began, and that's where that peak came. So we're looking at basically a fractal. We're looking inside, and we see that same pattern with more detail. So my point was, I wanted to buy it above this level right here, is what I'd outlined. I was on the Wolf, the Wolf Financial Spaces.
Yeah.
On November 3rd, I said, here's what I'm looking for. On November 4th, and this is always annoying as hell. You're playing your trade the day before, it gaps up, and it runs to 32.80 or whatever it is. I can't see the prices on here. Let me magnify that a little bit, actually. So it gapped up, and one of the concepts I wrote about 15 years ago, I wrote an article. It's for a company called tradingmarkets.com. Chase the gap or wait for VWAP. And, I used to get into trouble chasing gaps, going, hey, there it goes. I knew it was going to go. And I'd buy, and then, the stock would, not only give back all its gains first thing, then it would go negative and undercut a low from the prior afternoon. I'd spit it out and feel like, wow, what a dope I am. And then it goes later in the day. So I got tired of that, saying, is there a more objective way to do this? When we look at the volume weighted average price of those, and this is a 1 or 2 minute chart here. So the buyers got excited, and then profit takers came in. And then it started to tighten that range up a little bit. It got back above the volume weighted average price. And I tweeted it out exactly. I bought it, then I tweeted it, not to front run, but I want to get involved. I don't want to just sit there tweeting. I'm not a professional tweeter. But I said, here's where I'm buying right now with my stop below the low of the day at that point. So I was entering this big, powerful trend on the daily time frame, which was now confirming it on the 15-minute time frame, but timed my way into it on the 1-minute time frame. Mm-hmm. So a couple days, or that same day rather, the stock ran, here was my entry at 3682 or whatever, 38. I wrote that wrong. It's 3680. I'm sorry, that's daily R2. So one of my things is, like I said, I feel like my timing is pretty good. So I get involved pretty heavily here because my stop is below the low of the day. I generally sell some either at daily R2 or I use what I call the 2-minute exit. When it runs quickly to daily R2, I'll either sell a third of it there, or I'll look at a 2-minute chart and I'll say, as long as it makes higher lows on this 2-minute time frame, I will hold it until it breaks below the latest closed 2-minute period. So that got me out at 3904 versus 3860 if I had sold at daily R2, because the momentum was still strong. So that first third, I got an extra 44 cents by being in front of the computer in looking at it that way. So a couple days, what is this, on the 8th, so 3 days later, I had sold that first third there, and then I had raised my stop on a third to 38.45 because that was a higher low. But the day that this gapped here, I said, I want to lock in a bigger portion. So I set a third of it at 43.02. And that stop at 43.02 did get hit. So the first third for 222, 620 right here. And then intraday that day, I set it below the low of the day. And I got tagged the next day for 525 profit. So over a 6-day get hold, it was 12.5%. It was all done in real time on Twitter. I shared this. And then part of the reason I kept the stops tight is, this was my final sale, I believe, right here. Mm-hmm. I knew that the earnings were due, and I don't like to hold in front of earnings. It made its high that day, and here's where it was through the close yesterday. So, it was a good trade, and I'm never trying to get in right here and sell right there. Mm-hmm. But if I can get in like I did right here and get out on average around this area, 12% in 6 days, that's my type of trade that I like to look for. And then,
could I ask a question, actually?
Yeah, of course. Sorry.
Yeah, going back to your first sell at the daily R2, for people who don't know, what is the daily R2? What is that value?
Okay, this is good question. I would tell them first, Google traditional pivot point analysis. I've done a couple videos. You could do pivot point analysis, alpha trends. There's videos out there about that. It's a mathematical formula that was created by floor traders on the CME. They're called floor trader pivots. There's a lot of different variations of these pivots, mm-hmm. but they're based on the high, low, close. I forgot the formula. Divided by 2 and add this to it. But it basically takes the range, and it's kind of like standard deviations, basically. Right. Based on the prior day's range. And it tells you that, I've seen studies that, 90% of trading in any stock on any given day occurs between daily S2 and daily R2. Mm-hmm. But it's kind of like stochastics that most of it occurs between 20 and 80, but when it goes above 80, it's actually a buy signal. Right. So when it goes above R2, it's oftentimes, showing that there's extra momentum here. Anyways, it's a mathematical formula. A lot of program trades are based around that because it's a standard deviation. It makes sense for these programs, especially the high frequency ones, to take some off there. So you often see intraday, daily R2, it just nails it to the penny, and that's the high of the day. And same thing with daily S2 when you're short a stock. It'll nail it to the penny, never tick lower than that, and oftentimes go back to positive on the day. I mean, it's pretty amazing. So it's, again, just understanding the psychology of what drives the programs. It's not that I'm always going to sell exactly at that level. And sometimes I sell in front of that level. And today I did that on a short. I took some about 20 cents in front of daily S2, which was a good thing because it never came in and hit daily S2, but I was able to take my first third off with a decent little gain to reduce my risk. It's a good question. Yeah.
Yeah. And one more thing we haven't touched on too much yet is kind of position sizing. So I'd love to hear kind of, it might maybe for lucid trade, but maybe for another trade, what's kind of your kind of standard position size, if there is one, or is it kind of or do you kind of back into it looking at the risk you're taking and that basically decides the position size for you?
Yeah, it's a number of factors. So you want to have your R value. Let's say you have $100,000 account, and you're willing to say, I'm willing to risk $1,000, 1% of my account on any given trade. So if my stop is, in this case, what would this be? 60 cents away. That means I can trade approximately 1,500 shares. That's a $900 risk. So, but if I bought up here, my risk reward would only allow me to buy 600 shares.
Right.
But it's not just that. To me, it's where am I in this momentum campaign? If I'm getting in at the beginning of it, then I'll go my full position. But if I find myself chasing it up here, I'm not going to risk that same $1,000. I don't want to keep my stop down there because I'm saying to myself, at this point, it hasn't expended much energy. Over here, it has expended energy, and it's not as likely to continue at this rate of acceleration. Now, it did happen to this day, but that's not the normal situation. I'm more interested in what's normal. And when it starts to get extended towards daily R2, I'll feel like, well, I missed it. I'm not going to buy up here at daily R2. I'm not going to be that guy who chases it. It worked, but in hindsight, it worked. But often, 90% of the time, it trades within those, let's just call them standard deviations. So it's where we are within that cycle, and it's where we are in the overall market. The market was just starting to strengthen and coming out of that weakness that we saw in the overall market that we just spoke about. And what was leading the market at that time? Tesla was leading that market at that time. We saw Rivian, and this was part of my thesis for buying it as well, is that Rivian was coming public the week before. And part of what I was said on that Twitter space that day was, I think a lot of these EVs are going to run up in front of that because people are going to say, hey, I'm not going to be able to get it on the IPO. It's going to make these EVs high. And it becomes a self-perpetuating reality because guys like me are front running this event by buying the competitor and the hot new stock with the great chart. So that adds conviction to my trade. The market overall. So in this case, I took a maximum position size. What I didn't talk about is I actually added some calls too, just for a little bit of extra juice. And that often, especially when I juice it with the calls, I definitely want to take some of my profit off of the common that first day. And if I can pay for those call options with that first third, then I'm really in a position of strength because now I have the extra leverage and limited risk in those call options that are now at a profitable piece.
Perfect. So what is that kind of maximum size that you would go for?
For me, it's probably about 2 to 3%, of my overall portfolio, which might equate to, not in this case, but it might equate to up to a 30% position. It didn't, like I said, in this case. I think I took about 20% of my account value and put it into this. But I had high conviction, and I was, as soon as I buy it, I'm like anyone else. I have the same apprehensions. Saying, am I crazy getting this heavy? What's going on? If this thing reverses, I got to go to the bathroom. Man, maybe I shouldn't have gone. Maybe I shouldn't have bought it yet. I should have gone to the bathroom first. I'm going to have to sit here and hold it until I get some breathing room. So I want to get out of that uncomfortable position as soon as possible, but in a disciplined way. I don't want to just sell it because up 15%. I want to sell it because it's making higher. It's making higher. Every one of these 2-minute candles made a low higher than the prior one up to this point where this red candle right here. So there's very strong momentum, and I have to sit. I have to force myself sometimes to sit through that. It's difficult not to give in to that temptation and take some off. But again, when I have it in my mind and I have to remind myself, why are you in a bigger position? Because the market has just turned, because Tesla's leading once again, because we've got Rivian coming, because all of these EVs are starting to perk up. And this car just started deliveries that week as well. Right. I think I bought it on a Monday and I got an email from the company saying we just made our first deliveries. And these are sexy ass cars. You want these cars. They're cool.
Perfect. So you're aligning trends not just in the price data, but also that overall kind of event trends as well. That's really interesting.
Yeah, I mean, they just kind of came together. Right. They don't always. So, if I feel like, like today, the market is bleeding out a little bit the last couple of days, I'm still going to take long trades, but I'm going to do it with, 50 basis points of risk or 30 basis points of risk, right. Not 200 or 300, because, the odds aren't as good. But, just as I always like to say, it's better to be on the sidelines and cash wishing you were in than being in and wishing you were out. It's better to be in with a small piece and, being able to participate than it is being on the sidelines wishing that you were in and saying, I missed it. I knew it, because I used to do that early. Talk back to one of your earlier questions is, what were early mistakes that I made in my career? Early mistakes in my career were not to trust the stock based on the stock action and not get involved in a winner because I was concerned about the market. Things don't always line up perfectly. Most times they don't. So we have to adjust for that and adjust our risk and our risk on the individual trade in terms of risk management, and then money management in terms of portfolio and how would this impact my overall account if something catastrophic happened.
Well said, 100%. Perfect. Yeah, let's keep it going and sure. Check out the Bros trade as well.
Yeah, and Bros wasn't even a trade, and I tried to make this point, and this is a point that I wish more people would understand. I was on a Twitter space today, and the questions that people ask, hey, can you look at this stock? And I already know what stocks they're going to ask about. They're going to ask about Asana, which is in a horrible downtrend, down 50%. They're going to ask about Roku. They're going to ask about PayPal. They're going to ask about yesterday's winners. Everyone wants to buy these broken stocks. While the institutions are saying we're getting out of these things. Net, yeah, sure, Kathy's buying them. Great. What about the other 100 institutions that are selling to her? And I'm not picking on her. I'm just, she's become the cult that, hey, well, she's buying it, so I'm going to.
Right.
The trend is bigger than any one portfolio. It's bigger than the Fed. It's bigger than what President Biden says. It's bigger than George Soros or any other entity out there. The market dwarfs any individual participant. So, Bros was a hot IPO. It came out of the gate hot. It cooled off a little bit, traded a little precariously below the volume weighted average price from the IPO. This is a daily chart on the left. But then a big volume candle came in right here and buyers regained control. It got back above the VWAP from the IPO. So at that point, I knew that this low was an important low. So I anchored a VWAP to that. And it ran up nicely. I was trading it in here a little bit. It came down hard. And at this point, probably on this day, I put a volume weighted average price off that peak. Mm-hmm. Looking at it, saying it just came from, I don't know what these prices are, 40 to 75, 80. Mm-hmm. And, so it needed to cool off. So I said, well, maybe it can find buyers at this VWAP. This is certainly a level of interest. We saw the point of control change there. It's starting to find buyers. But what does that look like on an intraday time frame here 2 days later? So I said, a lot of eyes on it. So I spoke about it in my video. And then I started following up on it. So this was a couple days, maybe a week later, saying, that was our level of interest. But here's our volume weighted average price off the peak. Some people got excited and chased that gap open, but the 5-day moving average was declining. Mm-hmm. The volume weighted average price from the peak was declining. The sellers were still in control. That was a sucker bet getting involved there. It came back down all the way to the VWAP from the IPO, and that became a level of interest, not a place to do business. I was looking at it and they're saying, will it stabilize here? Let's wait for the evidence to show itself. it's potential support. We only know support and resistance after the fact. So it rallied up to the declining 5-day moving average and made another lower high and followed it up with a lower low. Clearly, the sellers weren't done with this yet. A couple days later, it's stabilizing near that VWAP from the IPO. And here's what I sketched out, saying I'm still not involved. I'm going to be patient. Maybe we're seeing reaccumulation in here, but it never flattened out and never made the higher highs and higher lows above it. So what I said here was that you don't see it, but now this pullback has become so deep that the primary trend is no longer higher because we're below declining 20 and 50-day moving averages. So now it's no longer a candidate for me anymore to be a buyer. So I don't want to buy this stock because it's basically broken. It's going to need time to heal. If they don't scare you out on the way down, they'll typically wear you out as it has to undergo that reaccumulation and start to, heal.
Perfect. Yeah, and I also, you didn't have it drawn, but during that IPO base, which I actually traded it up the right-hand side, I watched it right after it broke from the pinch from that IPO.
Oh, from this peak right here. Yeah.
Yes. Yeah.
Yeah, that was a beautiful pinch as well. And that was, and it was starting, and sorry to interrupt you, Richard.
Yeah.
But I was going to point out, that was part of what I was talking about in here is it was starting to pinch between there.
Right.
And that's just a signal that, we're getting, conflicting messages from the bigger trend, which is still higher, and the profit-taking trend. So let's wait for it to tighten up in that range and show evidence the buyers took control, which they did over here, as you pointed out. If we could sketch in a VWAP right there, it came down perfect. So, yeah.
Yeah, I was just going to ask you about that pinch, that overall setup, and if that's something that you're kind of looking for.
It is. I mean, it. I'm not necessarily looking for it, but I love to see it.
Right.
Because all it's doing is telling us that the range is compressing. We had this big big move higher. It's coming down and it's dropping the ball out of the 10th floor. It hits the ground, bounces up to the 6th floor, hits earth again, bounces to the 4th floor, to the 3rd floor. We get the compression of energy. Mm-hmm. Now, in the case of a ball, it's just going to dribble out. But in the market, we have supply and demand. So demand is in control here for the bigger picture. Supply took control right here. And if it consolidates between there, we're seeing that range tighten, and we're starting to see more of an equilibrium period where the longer term trend is still higher. The shorter term trend off the peak is starting to neutralize. So it puts us in that position where if it's, if that volume weighted average price off the peak were to flatten out, the 5-day moving average were to flatten out and were to start to turn sideways, the first higher high above there, like this one here as it came out of this pinch, that tells us the buyers are now back in control. Absolutely. The average short from the peak is losing money. The average long from the peak is winning money. The buyers are in control. If you're short, you're in trouble. How do you cover? What do you do to get out of your bad position? You buy stock, you cover.
Perfect. Yeah, that's excellent. Yeah. Are there any other key concepts with these trades or ideas that you wanted to cover, or is that pretty much it?
The big reveal is don't buy the dip. People say buy the effing dip. Buy strength after the effing dip. And honestly, I mean, I see it in the market today. I did it at one of these spaces today, and you do a lot of them, Richard. Mm-hmm. And, Gav says, hey, what stocks do you want Richard or Brian to look at? And they're always yesterday's winners that they want to buy. And they're broken stocks. They're stocks in downtrends. Stop buying stocks where there's a declining 20 and 50-day moving average. It's such a simple thing. Stop buying stocks with a declining 5-day moving average. Even if the 20 and 50 are rising, wait for it to prove itself. Bros never proved itself. So I watched this thing. I had it on my radar. Did I waste my time watching it? No. But I didn't waste my money buying it early. I didn't get in there and have unnecessary losses. In this case, this is a perfect example of you like the company, you see lines around the block at their coffee stands, whatever, the revenues are good, only price pays. Price never gave us a reason to buy. So in this case, cash was a position. You could turn around in hindsight say, well, what you should have done is short that thing. Like, okay, yeah, right, sure, you know everything. It's about trend alignment. It's about trend trading for me, not making every move in every stock, but where are they aligned? Where is the risk worth the potential reward? Can I manage risk, have momentum at my back on the bigger time frame, and buy that strength as it's just emerging on the shorter term time frame, confirming the strength on the bigger picture, and can I manage my risk there?
Perfect. Yeah, that's excellent. Brian, if you could stop sharing for just a second. I always like to finish it off with one last question. What kind of general advice do you have for new traders out there or new investors who are trying to find their way and just kind of, what can you say to kind of push them in the right direction?
Know your time frame, number one. I mean, if you're looking at people on Twitter, I always try to identify my time frame. Know your risk. I don't think it's seldom that I tweet a stock without saying a worst case stop would go here.
Right.
If you're not trading without a stop, you're having sex without a condom, and you're gonna be a dad, and you probably don't want to be, or maybe you do, whatever. That bad example. But the point is, know that there's risk in the market, and your job is to manage that risk as obsessively as possible. Right. If you have a strategy that helps you identify emerging trends and you can manage risk, once you have your position on, your job isn't over. You still have to raise your stops. The winners don't take care of themselves. You have to raise your stops. You have to not fall in love. You have to manage your emotions, your expectations. You have to manage all the noise that's on Twitter. I don't like to look at Twitter a lot. I never have CNBC on or any news. I used to look at that stuff and it cost me money because I would be influenced by it. And I was like, this is crazy. It's costing me money. I don't need to hear this stuff. And price tells me all I need to know anyway. Just if you can learn to, really just understand market behavior, technical analysis, multiple time frames, trends, stages, classic Stan Weinstein stuff, and manage risk, you'll do fine if you know your time frame and don't buy stories, buy price action.
Fantastic. Yeah, this was excellent, Brian. I really enjoyed this. For anybody who wants to reach out to you and learn more about your style and learn more from you, I'll have the links to your Twitter and alphatrends.net. But is there anywhere else that people, if they want to learn more, can get in contact with you?
Twitter's generally best. I mean, my YouTube channel, I put those on there, but Twitter's the best place that, I pay most attention to that, I guess. So Twitter would be the way to go.
Great. Those links will be down below in the description. To everybody watching, I hope you enjoyed. I know I really enjoy this discussion. I'm looking forward to watching it back and taking some more notes. But to everybody watching, I hope you enjoyed. If you did, go ahead and leave a like down below and subscribe to the channel if you haven't already. And we'll see you guys in future videos. Thanks.
Thanks, Richard.